Hi guys, this is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. Now in the today's class we will be revising due diligence and other chapters of auditing. I have already completed their revision and those videos I have provided them in the playlist. You can access revision videos of other chapters from the playlist section, and you can download this handwritten notes from our Telegram channel, and link for the Telegram channel I will be providing you in the description. Okay, now starting with the concept of due diligence. What is this due diligence? Generally, whenever any investor, before making investment into the company, he will perform due diligence of the target company. Whenever there is a merger, then the acquirer will perform due diligence of the acquiree in order to determine whether the investment into the target company is viable or not. So this is the purpose of due diligence. Due diligence is examination of potential investment to confirm all material facts of the prospective business opportunity. And what are the situations in which this due diligence can be utilized? Firstly, corporate restructuring. Whenever there is a corporate restructuring, due diligence will be performed. Generally, in case of corporate restructuring, creditors, they will forego certain amount that is due to them. So in order to forego the amount, creditors will perform due diligence whether this restructuring is viable or not. And venture capital financing, that is whenever any investment is being made into the company, that particular investor, he will conduct due diligence. And lending, whenever any lending is given, the lender also will perform due diligence. And leveraged buyouts. Leveraged buyouts means, let's say there is company A, company B. Company B is purchasing company A. Consideration is 100 crores. Now of this 100 crores, 10 crore belongs to company B, and balance 90 crore it has taken loan. With the loan funds it is purchasing company A. So an investment in which majority of the fund is borrowed fund, okay, that type of investment or that type of purchase will be known as leverage buyout. Okay, next, public offerings and disinvestments. In these scenarios, due diligence will be performed. And what is the main purpose of conducting this due diligence, or you can call it as what is the importance of this due diligence? Firstly, in order to determine true picture of the company, see, to confirm business is what it appears to be. Okay, if you see a company from outside, everything looks good, but if you dwell deeper into it, only then you will find serious issues in the company. So in order to confirm that whatever is being seen outside is the situation actually present in the company, due diligence will be performed. Next, to identify whether there are any potential deal killer defects that are present in the company, and then to gain information for valuing assets of the target company. Based on that valuation only, we will quote the price, okay, in order to purchase the target company. And to verify that a transaction complies with the investment criteria. Generally, investor, let's say there is company A, company B. Okay, company B wanted to invest in company A. Now each investor, they will be having their own investment criteria. If the target company fits into that investment criteria, only then the investor will show interest to make investment in the target company. So whether the target company is falling within the investment criteria of the investor or not, even to identify this also, due diligence will be conducted. And you should always remember that due diligence is different from audit. Okay, both are not same. And coming to classification of due diligence, or you can call types of due diligences. Firstly, we will be having commercial or operational due diligence. Next, financial due diligence, tax due diligence, information system due diligence, legal due diligence, and environmental due diligence. These are various types of due diligence. Now, there are certain general objectives that will be achieved while performing this due diligence. What are those general objectives? Okay, in all these types of due diligence, the general objectives will be following. First of all, to determine brief description and brief history of business of the company. Okay, brief description of business of the company, and then background of promoters. What is the background of promoters? And accounting policies that the organization is following, even that will be checked in case of due diligence. And management information system, and how management is structured, what is the management structure in the organization, and what are the trading results, how is the performance of the company in the past, and what is the current status of income tax assessments, whether there are any pending litigations against the company with regard to income tax, and what are the cash flow patterns that the company is generating, and what is the future profitability projection. These would be general objectives of any type of due diligence. And coming to matters that will be considered in case of financial due diligence. Okay, what are the specific matters that will be considered in case of financial due diligence? First three factors is same: history of the target company, promoters background, and accounting policies. Okay, these three you have seen here also. And then in case of financial due diligence, financial statements will be reviewed, and taxation issues will be considered, and then cash flow issues, even here you have it, and then financial projection. Okay, what is the future profitability of the company, and management and employees, and finally statutory compliances. These aspects will be considered in case of financial due diligence. Now, generally, if you are making investment into the company, you are conducting due diligence. The main objective would be to identify whether there are any hidden liabilities in the company. Okay, whether there are any liabilities that were hidden, okay, that were not shown or not presented to the investor by the management of the target company. In order to identify those liabilities, due diligence will be conducted, and also to identify whether there are any overvalued assets in the target company. So what could be examples of these hidden liabilities and overvalued assets? Coming to examples of hidden liabilities, whether any show cause notice was issued to the company, and whether such show cause notice has been matured as demand and is not disclosed to the investor, whether any such issue is present. Okay, that would be the first example of hidden liability. Next, letter of comfort issued to the financial institutions and not disclosed in the financial statements, even that becomes a hidden liability. And product and other liability claims, warranty given against the for the products that the company has sold, and we don't know whether warranty will arise on the product or not, even that becomes a hidden liability. Next, tax liabilities under income tax and indirect taxes, and environmental or any third party claims that are not disclosed to the investor, and agreement to buy back shares at a stated price. At the time of issuing the shares, the target company might have told that after 10 years we will be going to purchase these shares. Okay, we are going to buy back these shares at a particular price. Even that becomes a hidden liability if it is not disclosed to the investor. And unresolved labor litigations, finally future lease liabilities. These are some of the examples of undisclosed liabilities or hidden liabilities, you can say. Coming to examples of overvalued assets, uncollectible receivables, obsolete inventory valued above NRV. Generally obsolete inventory and slow moving inventory, it has to be valued at NRV. If it is valued at above NRV, it becomes overvalued asset. And even litigated assets, the value has to be factored to the portion of litigation. If it is not factored, then that becomes overvalued asset. In the same way, investment carried at cost, though realizable value is much lower. If realizable value is lower than the cost, then you have to value it at the realizable cost. If you have valued it at a cost, then it will become overvalued asset. Then investments carrying low rate of return. If investment is carrying a low rate of return, then the book value of that investment should be as per the rate of return of that particular investment. Okay, if you have not carried that book value as per the rate of return, then that becomes a overvalued asset. And intangible of no value, intangible assets of no value, and group company balances under reconciliation. These are some of the examples of overvalued assets. And what are the matters that will be checked regarding cash flows of the enterprise? Firstly, is company able to honor its commitments to the creditors and its loans, whether company is able to repay the loans in the within the due date or not. That will be checked while verifying the cash flows. Next, how well company is able to turn receivables and inventories. Generally, this is a cycle. Inventory will be turned to receivables, receivables will be turned to cash. Okay, what is the time gap between these? Okay, it should be as lower as possible. That will be checked. Next, how well the funds of the organization have been deployed. Okay, what are the areas in which the cash of the company is deployed, and is there any idle funds that is available with the company, and investment pattern of the company, and whether those investments that the company has made are realizable or not. Okay, this will be checked in case of verifying cash flows. Next, work approach to due diligence. Generally, first of all, we will review the financial statements that is submitted by the target company, and then we will assess business first hand by visiting the organization. Okay, by visiting the target company, we will assess the business of the target company, and then we will start our due diligence process, and finally we will prepare an offer based on the completion and findings of the due diligence. Okay, based on findings of the due diligence process, we will come up with a offer price. So now, how this due diligence will be conducted? How to conduct due diligence? Generally, there will be three phases. One is pre-due diligence period, and next due diligence process, and finally closing and post-closing procedures. First of all, in the pre-due diligence period, we will discuss with the client so that to obtain understanding of the transaction. Okay, if you have been appointed to conduct due diligence of particular transaction, we will discuss first of all with the client what is the nature of the transaction to obtain understanding of the transaction, and then we will discuss regarding scope of the work. Okay, what should be the scope and objective, and what should be the methodology that has to be followed, and finally we will coordinate the team. Okay, who should be included in the team to conduct this due diligence, that will plan. Okay, these three will be considered in pre-due diligence period. And during due diligence process, we will start due diligence process off-site and on-site. Okay, working off-site and on-site. Then we will involve in a question and a session with the management of the target company, and then we will draft our report, and we will support the client for preparing these negotiation terms. Based on the findings of the due diligence process, we will help the client to negotiate the price, and regular updates, we will be giving regular updates to the client during this due diligence process. And finally, closing and post closing, we will review the closing documents that are prepared by the target company, and we will also give PPA assistance. What is this PPA assistance? Purchase price allocation assistance. The price that the investor is paying to the target company, how it has to be determined. Okay, how much amount is allocated to each asset, that purchase price allocation will be assisting to the client. And then involvement in price adjustment procedures. All these will take place in closing and post closing period. And finally, contents of due diligence report. Basically these are some illustrative subheadings I have given. Apart from these subheadings, there can be some other subheadings also present in the due diligence report. We will see. First of all, there will be executive summary, then introduction, background of the company, what is objective of this due diligence process, then terms and scope, shareholding pattern of the company, management structure, and assessment of following 5 factors: financial liability, valuation of assets, operating results, statutory liabilities, and net worth. Comment on future projection, SWOT analysis, suggestions on various here you write various issues, suggestions on various issues to be taken care before and after the merger. These are some illustrative side headings that can be present in the due diligence report. By this, revision of due diligence is completed. We will meet in the next class with a revision of new chapter. Okay, and if you want to purchase classes, you can visit our website lecturepedia.in, and take care. Bye bye.